Some of the uncertainties that have been hurting the markets, particularly Greece and China, those uncertainties have been lifted somewhat, and that is justification for gold going down. But the flash crash that we saw overnight, probably has a lot to do with liquidity as well.
It's a combination of stronger dollar, the fact that the geopolitical risks in the world haven't been severe enough to push the market, and also we have not seen a big reaction from the emerging markets to the drop in the low price yet. And the combination of those things have driven bullion lower. We're still looking for the market to recover back over and stay over 1,100, and any dip below there to be relatively temporary.
Gold is really tied to what the Fed is going to do and when it's going to make its first rate hike. So I think directionally speaking, that's why gold is out of favors with investors. 1,100 is a good support level, but I guess once expectations are cemented around the timing of the first Fed rate hike, and there's still some uncertainty around that, then we're going to test below that, and I think we're going to eventually get to the psychological level of $1,000 an ounce.
We've seen probably a low point here, and there will be some accumulation gold at these lower prices to help some of these companies out that are the miners and things that are just getting slaughtered as we go forward here. So at that point, I think it's time to want to be a buyer because I think it's a good hard asset to hold.
Sentiment, especially among the institutional investors as we started off, has been very negative, and that's going to weigh heavy on gold. But as Alex was bringing up, it's the supply that's really going to make a difference here. Every time we've seen in the last 5 years gold dip this low, it's because of the miners' break-even costs that limit supply, and that then brings up, with the demand from both India and China continuing to be strong, that's going to give support for gold around this range.